Okay, recording. And then I'm going to share screen. And then I just want to make sure I am recording this correctly. So give me one more second. All right. I think we're looking good. All right. Well, thank you for everybody bearing with me. Got going a few minutes late here, but good afternoon. My name is Leola Carter, and I am your host for today's webinar. I am a SCORE mentor in the Minnesota division, where we have over 90 volunteers serving Manatee and Sarasota counties. I am also on the education committee and excited to bring to you today's presentation on tax saving strategies for business owners with James Springer. This is a small change from my original plan. So when that started to fall through, I knew James would be up for the challenge. Before Mr. Springer begins, I have just a little bit more about us here at SCORE. We are a nationwide nonprofit organization that's an independent part of the Small Business Administration. What SCORE can do for you? We provide free mentoring services and educational services such as this webinar. We can help in all stages of your business process, from your first initial thought all the way right up till where it's time to sell. You can find us at score.org/Minnesota, where you can find all of these services. And today would not be possible if it weren't for our sponsors and community partners that we have listed here. And now I believe it is time to introduce James Springer, who has over 30 years experience in the wealth management industry. Born and raised here in Florida, he's here to help us business owners with our 2023 year-end tax planning strategies. And go right ahead, Jim. Oh, I can't hear you. Let's see here. Do you have on the bottom of your screen a microphone? No, I still can't hear you. Let me think. I'm going to get out of that screen. Let's see. Go into this one, see if I can help at all. Oh, what? Anything, Jimmy? Let's see on your end. Little microphone down in the corner. No, I still can't hear you. Well, I'm not sure what else to do, because there should be a mute button on your end, on your side, and you might have to take yourself off mute. Or worst case scenario, you could give me a call and we could talk it through that way.
All right, does this work a little bit better here?
Oh yeah, okay, it's doing better now. I can hear you. All right.
Okay, great. So I'm glad we're able to all connect here today.
Thank you.
If all else fails with technology, just use an iPhone. Let me go ahead and close this one off. All right, that's a whole lot better, so we don't have any feedback. Yes, so thank you everyone for your time today. We're going to be talking about a subject matter that, since they changed the tax code in mid 2000s, that business owners such as yourself have been able to take advantage of. So I've always told clients for the last 30 years of being in this business is we always like to want to invest like Warren Buffett or Mitt Romney. You don't have to have Warren Buffett's money or Mitt Romney's money to be able to take advantage of the same tax breaks that are available. And even when Jeb Bush was running for president here in the last couple of years, his small business, he was taking advantage of with his consulting firm and legal practice, what we're going to be talking about today. He only had 4 employees, but it was a way in which he was saving over $300,000 a year in income tax. So that's going to be our subject matter. And for those of you that might be in Florida, you might be thinking to yourself, well, how does this apply to me? And is there a way to get a tax mulligan for 2022? And believe it or not, the answer is still yes. And the reason for that is for us in Florida, the hurricane. Everybody's tax returns have been extended until February 2022. So if you talk to your accountant and they're giving you a surprise on the amount of income tax that you will have to look to pay back in 2022, there is still a means for you to be able to get a tax break going back to last calendar year. A lot of this has to do with the fact that they changed the tax code here recently with the Secure Act. And what this allowed was for the ability, we were always scrambling in November, December of each year with business owners which they knew exactly what type of return that they had on their business, and they also knew what the tax implications would be. And they always were at the end of the year trying to look at ways they could get tax breaks for the current calendar year. That's the way it's been for about 15, 18 years. Well, what changed with the Secure Act in the last 2 years, and this is something I've been doing continuing education with CPAs, attorneys to make them aware, is we don't have to do this last minute scramble anymore. You literally, because of the Secure Act, have the ability to go ahead by getting a plan inked in place with this calendar date, 2023, you can get a tax break going back to 2022 if you are a Florida business. If you're not a Florida business, no big deal. You can still get a tax break for 2023, and your quarterly estimates will immediately start going down. So that's what we're going to be talking about today, is a way to be able, as a business owner, to get an above the line deduction that you can create retirement wealth through a tax break. It's a way to really create some compounding of your money instead of writing a check to the government. So Leola, if we go to the next page.
All
right. So let's talk about another interesting wrinkle that has been put in place when they decided to go ahead and give these additional tax breaks to business owners. And I'm a big believer, sometimes it's easier to remember things with a story. So here's the story. Back when President Trump started this additional tax break for corporations, C corporations, they literally dropped the tax brackets down measurably. So corporate America, their tax brackets literally were dropping down upwards of the highest brackets upwards of 39.6. When they put the new tax brackets in place, capping the federal for individual at 37%, well, they also made a means to where they allowed for further deductions to be made available for C corporations, literally allowing them to go ahead and push down their taxes down to right around 20%. So ultimately, Congress, in their infinite wisdom, realized you can't have every doctor practice, lawyer practice, air conditioner, plumber, consultant, small business owner all become C corporations to get the same tax break. So they decided to go ahead and put in what was known as a QBI, qualified business income deduction. And so this slide right here shows who qualifies for the new 20% pass-through income deduction. And what you'll notice is that for any income that's $315,000 or less, do you qualify? Yeah, you qualify for the 20% QBI for any pass-through entity. Now, the catch then became over 315 to 415,000. Well, there was limitations associated with it. And anything that was over $415,000, well, ultimately, once again, you were limited, and it couldn't be a business type that's not a specified service business. And over $415,000, no deduction available. Well, I've got clients that own small businesses, and they're saying, how can I go about getting this tax break? How can I go back to be able to qualify for this extra 20% QBI, given the fact that my income is above the current levels? Well, there's a couple ways you can do it. For those who are buying, assets, equipment, things where they can get accelerated depreciation. That's a way in which they can go ahead and reduce, income and get tax deductions. But the 800-pound gorilla that's available to play cleanup is implementing a cash balance plan. So Leo, if we go to the next slide. So here's a good example. And in this example is just taking somebody who has a part of a medical practice. So you take example, this doctor here that age 60, married, currently doesn't have a cash balance plan in place. He's got a 401k in place, but with a 401k, there's limitations on how much you can put away. And so I come along and I educate him or a CPA and say, well, what if we were to go ahead and look to go ahead and reduce your current federal income tax, which you're paying 37%? How would you feel if we were to go ahead and drop your bracket down to 20.1? Well, of course, that would get your attention. And so ultimately what you're seeing here is that combining, a 401k, it's just a little base layer of a way you can get a tax break. You're limited on how much you can put away, and same thing with your employees. But what we do is we customize and layer on top the icing on the cake for the business owner that will enable them to be able to put away hundreds of thousands of dollars. Because in this particular example, someone who has this type of income, for every $100,000 they're making, they're literally writing a check to the IRS, the US government, for $37,000. So instead of writing that check to the IRS, what they're doing is for every $63,000 they're putting into their plan, they're not having to write a $37,000 check to the government. And ultimately, that thought process, as you'll see here, is that this position, by putting it in a combination of their 401k and cash balance plan to where it totals $335,000, the $650,000 of income minus the $335,000 now drops their aggregate gross income to $315,000, allowing for the 20% pass-through deduction and effectively reducing their tax bracket rate to 20.1%. That's a big deal. So I've got clients that are putting away hundreds of thousands of dollars to be able to take advantage of the same illustration of what you're seeing here. In fact, I have a client who put away $1 million in their business to be able to push their bracket down to what you're seeing here. A lot of flexibility in these plans. And we also have the ability with the actuaries that we have on staff each year, depending on what your business income may be, you can, in better years, put more money away. In leaner years, put less money away. Ultimately, it's a big math equation. It's not something your accountant can do. Accountants aren't actuaries. It's not something your financial advisor can do. They're not actuaries either. This is something that, from a customized planning standpoint, our actuaries on staff are able to tailor a plan specific to your needs. So if we go to the next page.
Oops, sorry, I'm typing in the chat box. I'm sorry about that. I will get to the next page. Let's see. There we go.
So you might be thinking to yourself, well, I just gave you an example of somebody who's a 60-year-old example here. Well, what about different age rates? So different, from somebody's 30 to 34, what are they able to put away in a 401k? 20,500. 401k with a profit sharing plan, 61,000. They can layer on top of this cake, the 401k and profit sharing, another 71,000, bringing the total up to 132,000. And you'll see that's the way it works up until the age of 50. 50 is a little bit of a magic number in the world of 401ks, because in 2022, 401ks, you could put away $27,000, an extra 6,500 bucks. And the profit sharing 401k combination, 67,500. The cash balance has really moved up, to 191,000, bringing the total to 258,000. And the 60 to 65-year-old, you can literally see that they too can put in 401k profit sharing, the 67,500. Cash balance another 300,000, bringing it up to 368. So in that particular example, when you're able to put away $300,000 and you're in a top tax bracket, you're literally saving 37% of that in Florida and states that have state income tax. You got to layer that on top. So literally for every dollar you're putting away, you're saving 37 cents in Florida to over 40 cents on every dollar outside of the state of Florida. So this gives you a little bit of the ranges that are available from a how much can you put away standpoint. You do have the ability to put even more money away if it's a bigger year, to where we call it overfunding. So great year, overfund, put more money away, get the larger deduction. In a leaner year, then you look and say, well, I overfunded in that great year. This is a leaner year. Maybe I want to skip the year. Maybe I want to reduce the amount. Our actuaries will go ahead and calculate those adjustments for you on an annual basis. But this gives you at least some good ballpark numbers based off of your age of what, as a business owner, you're going to be able to take advantage of and putting them as far as money away. So Leo, if we go to the next page. So ideal candidates here, business owners who are making more than $250,000 a year, that are interested in a tax deduction more than $50,000. Businesses of all sizes, all types. Family businesses or closely held businesses are great because you can get a multiplier for your family members of them being able to put away large dollars, as well as you as a business owner. CPA, law firms, medical groups, professional firms, consultants, people who are on a board that has consulting income, realtors, those who have a high wage and are interested in large tax breaks would be the demographic. Or, as you saw in the previous example, people who are older who are saying, it's now time in life to where I want to play catch up. I'm literally trying to go ahead and squeeze 20 years of retirement into the next 10 years. So the same concept of, 401ks are great. They're limited on how much you can put money away. You saw the limitations, $27,000, upwards of $67,000, layering and profit sharing. But ultimately, if you're looking to make larger deductions and take advantage of that QBI with further tax breaks, then that's where we would come in to be able to tailor something to meet your specific needs.
I do have one
Next
question. Oops, sorry about that. One question, and somebody wanted to know, what about business owners over the age of 65?
Oh, perfect. And that's a great question, because the older you are, the more money you can put away. And here's the reason why. That previous example, you saw the 30-year-old, that they were limited on how much they could put away. They got a longer time frame until retirement. Well, those who are 60, 65, 70, well, you're a lot closer to retirement. I'm not too far away from retirement myself. And so you're able to go ahead and put larger dollar amounts. And it's a great way for, especially for business owners that are maybe looking for a way to transition. They're looking to get these large bites of the apple of large tax breaks, and Maybe they have somebody that they plan on selling their business to. Maybe it's a younger member, and there are strategies to where uh, the dental practice owner, the older dentist, is looking for a way to transition to the younger dentist who's wanting to buy in. And so it's a way in which they can go about through a cash balance plan, saving taxes for both parties as far as that buy-in. We see it be very common in dental practices, legal firms, closely owned businesses by families. This is another mechanism from a mathematical standpoint that can make sure that you don't overpay. But the older you are, the more money you can put away.
Perfect. Thank you.
So if we go to the next page. So you might be thinking to yourself, well, what are all these other taxes that you're able to go ahead and save? Well, I mean, we talked about corporate taxes. We talked about, that the cash balance contributions, that they're a deduction against business income. Personal federal taxes. Well, any shareholder or partner that receives a K-1 as a result of corporate or partnership profits, well, that rolls into your personal return. And by you implementing a cash balance plan, it helps to reduce the taxes on that personal return. When we take a look at where the federal tax schedule is, the top marginal income is at 37% for individuals over 539,000 or 647,000 for married couples in 2022. While a cash balance contribution can allow for you to be able to reduce that marginal income below that 647, and you can literally reduce your tax bracket meaningfully by just going ahead and putting away money to create retirement wealth through that tax savings. When we look at personal state taxes, I mean, again, state income taxes, they can range as high as up to 13.3%. So again, it's another way in which you're reducing not only your federal, but states like California, that the state income tax can be as high as 13.3. Personal investment tax. Well, the cash balance plan deduction may put a household under the net investment income tax threshold, eliminating the need to pay that extra 3.8% net income investment tax for any earnings that are over 200,000 as an individual or 250,000 as a married couple. So that surtax applies to investment income such as capital gains, dividends, rental property income. So again, another way that you can go about reducing your personal investment tax. Medicare tax, well, that's where they get you for another 0.9 on payroll tax on wages, self-employment income for anything above $200,000 individually, $250,000 for married couples. So cash balance plans can help to reduce and lower income to reduce that tax. And of course, I would say the additional part of that 800-pound gorilla is this whole QBI, qualified business income deduction. So for business owners, professionals, the cash balance plan can really help in making eligible for the QBI deduction. So this deduction is provided to companies that are structured as pass-through entities, sole proprietorships, partnerships, S corporations. Taxpayers who qualify to receive a 20% deduction of the income on their tax return. So many professional businesses like doctors, attorneys, consultants, actuaries, CPAs do not qualify for the QBI deduction unless their income are below certain levels. And those certain levels are $220,000 for a single return or $440,000 for a married couple in 2022. So 7 different ways that you get a compounding effect of further tax deductions. Go to the next page. So at the end of the day, what we're talking about is turning your tax savings into retirement wealth. This effectively is going to allow you to achieve the largest allowable deductions and tax favored status with the IRS. And at the same time, it also enables you as a business owner to be able to reap the major benefits, but at the same time control employee costs. So let's talk a little bit about that, because the IRS has given quite a gift here through these cash balance plans. What's involved with the employees? So Leo, if we go to the next page.
Okay.
So what you have here is an example of somebody who is an owner. He's the age of 62, he or she, and they've got their compensation at $285,000, and they are putting away their $26,000 in a 401k, $15,000 into a profit sharing. And for the employees, you'll see they're different ages. 27, 30, 34, 25. So the profit sharing, they're putting in $1,400 for the 27-year-old, $2,600 for the 30-year-old, $2,800 for the 34-year-old, $1,500 for the employees, 25. So the owners get putting 25,000, but you'll see at the bottom that there's 24,000 that's put away for the profit sharing component. The employees can choose to put their own money away in the 401k if they want to defer. So again, when it comes to the cash balance, this is the 800-pound gorilla. We come in for the business owner and we put away $294,000 away as an above-the-line deduction. They have to put some money away for the employees, $350 each, you'll see here. And then so ultimately, at the end of the day, what's taking place is the owner is putting away $336,403. That's their deduction. The employee contributions, they're having to put away $9,900, $9,906. So the owner literally retains 93% of the contributions and does not have to write a check. Literally saves $128,000 by implementing a cash balance plan that's custom tailored, for their business and their personal needs. So what we have the ability to do is, based on your business, we would require to get a census. So the same information you give your payroll company. When did these employees start? What's their salary? The way the ownership structured is currently structured. And we're able to go ahead and run an example to the penny, be able to show you exactly how much in tax break that you're able to receive. And then for the money that you put in for the employees, what that looks like. And you might say, well, there's money I'm giving to the employees. Can they go spend it now? No, they don't get to spend it now. Ultimately, this is something that is effectively setting up a pension for them for their future. So it's something that's a nice way to be able to thank them for their service. They also, based on how you elect as a business owner, they have to work through a vesting schedule. So maybe you set it up to where you got to be here for the next 3 years or 5 years. And if it's 5 years, you're saying to yourself, well, you get 20% of that each year. And if you're here for 5 years, then you get the full vested benefit. So it's a win-win, because as an employer, you're wanting to hire the right people, you want them to stay around, you want to see them succeed, and provide a means to where they're able to go ahead and create some retirement wealth, and you're able to go ahead and receive large deductions. It's a win-win for all parties at hand. We go to the next page. So with the Secure Act 2.0, one of the things that, as I mentioned, this whole year-end scramble that we used to do for many, many years, going back to almost the last 15 plus years, that's been eliminated. We have the ability to where we can literally put these plan in place and give tax mulligans for the year prior. So for those of you who may not be in Florida and you missed the drama with the hurricane, you might be saying, well, what can I do now? Well, you can go ahead and get a plan put in place that will at least enable you to save 2023 income tax. Whereas if you're in Florida, you can still go back and save last calendar year. And literally, we can go ahead and put these plans in place up until March is the business filing tax line for business owners. I tell all the CPAs that we do continuing education for, make sure you have your businesses extend until September, because they're going to want to see the math. They don't want to have the sticker shock of how much an income tax that they have to pay, when they would have the ability up until next September to get the benefit of this above line deduction to save the prior year income tax. So you might say, well, why would I just want to wait until next year to get any of this in place if I'm outside the state of Florida? Well, the fact that you would get a plan put in place now allows for you to immediately benefit of your quarterly estimated tax payments to start going down now. So that's the financial motivation that we have for businesses across the country. They literally will put plans in place in January 1, because they want their next quarterly estimate to meet immediately reduced. We have business owners who now we're going into November that are saying, well, I want to go ahead and have my December quarterly estimated reduced. And I also want to get back that money that I paid already this year in the form of getting a cash balance plan in place. So that way I'm paying myself instead of overpaying the IRS. So that's all the motivations. For those of you who maybe have not even set up a 401k yet, for your rank and file employees, there's a big motivation right now with giving business owners tax credits for setting up a new 401k. That's another subject matter. It's information I can send over to you. But ultimately, the government wants you to set up these 401ks, and they're willing to pay you to do it. And here's the moral of the story. The government realizes is that by enabling money to grow faster in retirement plans and not being taxed each year, money grows faster when your money grows interest, and the interest on the interest grows, and you're not paying tax. That's what the purpose of a 401k, an IRA, it allows you to create a compounded retirement wealth a lot faster than paying income tax each year. So why would the government be motivated for this? Well, they want down the road for people not to be reliant on the government. Social Security, when it was set up, was not meant to be your retirement plan. In fact, a little quiz fact that you can win on Jeopardy on why was the age of 62 selected for the earliest Social Security withdrawal? Well, it wasn't science that decided this. FDR, during the World War II, they looked around and they looked at the Germans as an example of setting up Social Security. And it was set up by the Germans in the late 1800s by Otto von Bismarck. And the reason why Otto von Bismarck chose the age of 62 is because no one really lived to the age of 62 in the late 1800s. And so when FDR went ahead and put age 62, they just borrowed what the Germans had been using since the late 1800s. And then here we are today. For all of us that are getting close to 62 or 62 or older, we realize that 62 is the new 42. And people are living longer. The government realizes some of the fastest growing demographics are people reaching the age of 90, 100 years old, a couple today reaching the age of 60. Statistically, there's a 48% chance that someone's going to make it to the age 93. So the government realizes that people who are taking a Social Security at 62, they could literally have another 30 years that they're needing to be able to provide for themselves. So the bottom line is the government wants to make sure that the American people get ahead, so that way they got a safety net that's put in place for you being able to put your own money away to compound wealth. And this doesn't sound like a lot, but this just shows you how easy it is to have $1 million. If you'd have just put away $100 a week and you did it for the last 25 to 30 years, depending on your timing, you literally have $1 million. It's literally that simple. But unfortunately, a lot of people were not putting away $100 a week in the last 25, 30 years in the Dow Jones or the S&P 500, and had that compounding effect. So think of these plans as just a way to where money can be compounded. You as a business owner are able to get this, 10, 20 times more money put away than you could in any 401k program. and literally play catch up, with large deductions and large contributions. But in turn, by establishing a 401k plan for your employees, that in itself will allow for them to put their own money away and compound it. So that way they're not relying on the government down the road, and they have something to be able to have some financial freedom. So with that being said, well, happy to open up the floor for the questions that there may be at hand.
Okay, I do have some in the chat right now, and I also have some in Q&A. So I'm going to ask you a few in the chat. I'm just going to scroll back. One question is, I'm assuming that this is a high level for businesses making over $50,000 and above. Are there any incentives for businesses that are not at those levels?
There would be. That gets into establishing a 401k program. There are tax breaks that the government will give you as a business owner for establishing this, and they're giving you credits. The cash balance plan is really geared for business owners that are earning more than $250,000 a year and are looking for large tax breaks.
Can you speak to taking large tax breaks / deductions and home ownership? A lot of peers have run into issues with reportable income versus affordability and have to consider a cosigner. So can you speak to taking a large tax break or deductions and home ownership, if that makes sense?
So in regards to home ownership, one thing they did change in the law is from a itemization standpoint for mortgage interest, that it was up to $750,000 of a mortgage you're able to go ahead and itemize against your personal income. It used to be $1 million, but they reduced it down to $750,000. In regards to reportable income versus affordability, again, this question kind of alludes me to the purchase of a home, which is a different subject matter than our conversation here. But in regards to that, it all gets back to bank underwriting. And so whether or not the bank that you may be affiliated with or working with, there's certain guidelines of which, based on the mortgage amount, that are being literally have to be underwritten to be sold on the secondary market by Fannie and Freddie Mac guidelines. So Fannie Mae and Freddie Mac are government entities that regulate mortgages. And so a lot of banks, based on the thresholds in your area, if it's just a regular conforming loan, only that bank is doing is they're underwriting the loan and it's sold off based off of government regulated standards. For jumbo mortgages, those are the ones that tend to be kept by the bank, and there can be different underwriting standards associated with those. In regards to cosigner, again, that's a component of the debt to income ratio, what income that you're showing, and if you're needing to qualify for a home mortgage and you need to be able to show more income, then that's where cosigners come into play.
Do you have to pay Medicare tax if you are already working a full-time job in your business for supplemental retirement income for the future? So do you have to pay Medicare tax if you are already working a full-time job and your business? Supplemental retirement income.
Again, that's going to be a different subject matter than what we're talking about today with as far as tax deductions. But in regards to the cash balance plan, as one of the 7 points that were mentioned, it does help to reduce, that particular Medicare tax.
Okay. Will this apply to capital? It says capital game. I'm assuming capital gains. I just had to pay from selling my investment property.
Okay, good question. This is the deductions that we're talking about here today on a cash balance are based off of earned income. So it's business income that you have from your earnings. Ordinary income is subject to the higher taxation levels, the federal being 37%. And of course, you got to add, if you're in a state with state income tax, it could be as high as another 13%. So people in California and New York, it's between a combination of the two, they're paying 50% or more in state and federal income tax. And that hasn't even gotten into the other taxes that may be associated. Regards to your question in regard to the property sale, that in itself is going to be subject to capital gain tax. Anything that is less than 1 year, it's the capital gain is short-term capital gain rates, which is the same as ordinary income. Whatever your rate is at ordinary income, anything that is long-term capital gain, can range depending on your overall income. Predominantly, most people pay 15 to 20% on that, and then they can also end up paying another 3.8 for what was coined like the Affordable Care Act tax. But you're not able to go ahead and shelter that through a cash balance plan because that's not considered ordinary income. What you are able to do with property, and our firm's been in business since 1890. We're in the United States, Canada, Europe, Israel. We're one of the premier investment banks, and we're not owned by a bank, so we're able to tailor a lot of customized solutions for clients. But we allow for anybody who's selling property, we can do 1031 exchanges, Delaware Statutory Trust, DST 1031 exchanges, to where you can have fractional ownership of an Amazon warehouse, senior living facility in Arizona, apartments on the beach in Florida. You can be part of multi-million-dollar institutional deals and do 1031 exchanges if you're not wanting to pay the tax on investment properties that you may be selling. There's also opportunity zone investments that will allow you to go back in time 180 days to be able to get tax breaks on any capital gain that you may have received.
The next question, and I will try to go back to the slide as you're answering. It says, could you please explain again why the owner retains 93% contributions with the possible tax savings of $128,130? The owner contributes the $336,000 toward the 401k plan.
Yeah, so if we go back to that slide.
Did I miss it? Oh, there we are, I think.
Yeah. So what you'll see here is that the owner, age 62, their compensation, is $285,000. So the owner can elect to put away $26,000 of their own money. And then from an actuarial calculation, they're able to put $15,557. So that's that 401k and profit sharing combination. And then the calculation will allow for them to put another $294,000 away above and beyond that, which drives their total annual contribution of money that they put away, $336,000. And based off of their tax bracket, they literally saved $124,000 personally. And then when you layer in the amounts that are being contributed that you see here on this slide, you'll see that the annual contribution and the amount of deductions that were available, are as itemized. So for your business, we can show you specifically based off of the census material, your age, the salary that you have coming in, age of that of your employees. We just need to know the start date if they're new employees or not, because new employees don't get the benefit of participating. They have to have, a time frame, typically a year before they're able to come in. So that's the basic information that our actuaries need to be able to run the calculation.
Okay. On your example of how to become a millionaire, was the $100 a week turning into $1 million based on money invested in the S&P?
Yeah, you just took the S&P 500 and you compounded it, S&P, the Dow Jones, for the last 25, 30 years, depending on your timing, and it ends up pushing right about that $1 million.
All right. Let's see. We already have a 401k plan. Do we start the cash balance plan program conversation with the company that facilitates our 401k?
Good question. The 401k vendors that are out there, they're not actuaries. They don't do this type of work. We have started to see a trend to where plain vanilla, cash. Some of the vendors we work with, about every vendor that's out there as far as 401k provider, and so some of them will allow for a very plain vanilla cash balance plan to be put in place, but it doesn't give the flexibility of being able to do overfunding, underfunding, and customization of having a TPA, third party administrator, handling this. So if you have an existing 401k, if you're happy with the vendor, keep it. Well, only thing that we're doing is we're coming in for you as a business owner, and we're customizing something that you can layer on top of your existing 401k to be able to get much larger tax deductions for yourself, and then also have something that's customized for you. Similar to building a house, you can build a row house or you can build a custom house. The same thing applies with these TPAs, third party actuaries. There are some that just are row house people, and then, just like a general practitioner is a physician, and there are cardiologists and neurologists for a reason. So, more of a specialist based on what somebody may need.
Thank you. Somebody would like to know also, is there time for this to be implemented for the 2023 tax year?
There is. In fact, one of the motivating factors that you would have for 2023 would be the fact that your next quarterly estimate would go down. So if you want to start, instead of writing that quarterly estimate check to the extent that you've been to the government, instead you want to write it to yourself and to your cash balance plan. That would be your motivation to get started earlier versus waiting.
Excellent. The next question, how would the business account for this type of plan? What does it look like on the books, sort of from an accounting point of view, if that's possible? So how would the business account for this type of plan?
Yeah. So it's a retirement program that's put in place with an above the line deduction. And one of the other major benefits that we have helped, my firm, we bring more companies public below $2 billion than anybody on Wall Street. In fact, I had a couple clients that, we did some investment banking to be able to sell their businesses. And one of the fringe benefits of a cash balance plan is the mechanics. It's all approved by the IRS, compliant, and it's something from a sales standpoint. When you're able to go ahead and position a sale of your business, and the buyer sees this big tax break that you've been receiving over the years, they realize that the numbers that you're telling them are the numbers. It's just another way to where, from a verification standpoint, they know that you would not be putting this plan in place unless you were making the money that you were stating you're making. It's being verified by actuaries. And that in itself, I've seen when business owners are selling their businesses and have a cash balance plan in place, they're able to really get a better multiplier, because the next buyer realizes that they're not only buying a business that the verifications of everything are more formalized, but they're also seeing a concept that they then themselves can use in the form of getting their own deductions.
For the 2022 year, so looking back to last year, what is the cutoff date to revise last year for this program?
So we all, as business owners, you got March that you can file your business tax return with an extension. That was continued until September, but due to the hurricane, that was pushed out further into next year. So this is something from a mathematical standpoint. You don't have a plan in place. There is a way from our TPAs that we have that they're allowing for you to be able to gain that deduction for last calendar year.
Okay, this next question I love because I asked you this question about my company. We currently offer a simple IRA. Is the 401k a better option along with the profit sharing? And I remember asking you that exact same question.
Yes. So one of the things that you're able to do with 401ks, and again, think of all these different vendors that are out there. There's 401ks that are good for startup And then as the assets continue to grow, then it's time you outgrow your previous provider to another provider. And they're all offering different bells and whistles, in regards to some 401k vendors. They're providing, free 529 college plans that the participants can put in place. Some of them provide basic legal services. The drafting of a will is part of a 401k vendor offering. They're trying to differentiate themselves. Some of them have better technology on your smartphone. But from a deductibility standpoint and a contribution standpoint, other things that have changed in the form of a 401k is enabling you to do what is called a backdoor or mega backdoor Roth. So Roth contributions are limited based off of one's income. So when somebody's making too much money to be able to contribute directly to a Roth IRA, there's two ways they can do so. They can do a backdoor Roth IRA, which is putting money into a traditional IRA, $6,000, $7,000, whatever they want to put away, and then they convert it over and move it to a Roth. So it's that extra operational step. Take that same concept with the mega. I love these words, right? Mega backdoor Roth. What we do is we customize our 401ks to where this provision's made available to where once you fill up the deductible portion, your $20,000 to $26,000, we then make available to where you can throw an extra $37,000 of, instead of putting that money in your checkbook, we use your 401k as a means to drop in the $37,000, and then we shoot it out to a Roth IRA. And now you have $37,000 that the government can never tax again. So simples are great when you're starting out. As the value of those assets continue to grow, 401ks will enable more money to be put away, not only by the business owner, but also by the employees if they're electing. And then there's also other fringe benefits that can come into play with a 401k. And above and beyond that, the ability to take advantage of this Roth component is something that can be tailored. So it all gets back to the math, where we can show you specifically, this is what you have, pros and cons with your simple. This is the math of pros and cons of what you gain with 401k. And then as a business owner, you make a business decision.
Great. This next question you might have already answered, but it was typed a little differently, so bear with me. It says, if a Florida business already filed their 2022, can that be amended?
Okay, for your business tax return?
That's
if you've already filed, and now we're in 2023 for you. So the best that you can do is now start getting the benefit of reducing your quarterly estimates and get a plan inked in place now, and you immediately start saving for 2023. Unfortunately, because you already finalized your business tax return, that mulligan is gone.
Okay, thank you. At what point in reference to revenue does it make sense to establish a 401k and a 401k cash profit sharing plan?
Well,
at what point in reference to revenue?
Either you pay yourself or you pay the government. So ultimately, when it's all said and done, and your accountant's meeting with you saying this is what you're paying in income tax, and then your question is do I really have to pay that? Yes. Is there something I can do about that? Well, that's what you're learning today. A lot of the planning that you're doing here now will enable you to be able to save now for 2023. You go into next year, and you're going ahead and you're meeting with your accountant in February, January, March, and a lot of the tax breaks that you could have received and planning before the year end, you missed it. So that's why I've got a job. I'm a certified private wealth advisor. Basically, it's a certified financial planner for wealthy people. You'll see the definitions, people have a net worth of $5 million or more. I'm also a certified investment management analyst. So I went to University of California, Berkeley for that. My CPWA went to University of Chicago Booth School of Business. So in the world of financial advisors, there are ones that are general practitioners and there are ones who are, cardiologists. And I'm a cardiologist using that analogy, for my background education and the clients we serve.
That is great. Thank you so much. I just wanted to let the participants know that you will receive a copy of the slides and today's video presentation in your email. I would like to thank everybody for attending. We will send you a survey so you can let us know what we can do to improve or other topics that you may be interested in. I do see one more question, if you don't mind. Did you mean should a business considering establishing a 401k cash profit sharing plan when they bring over $250,000 in revenue or sooner? Did that make sense?
Yeah. So ultimately, what feeds through your return is ultimately what you pay income tax. And again, this all ends up being a big math equation. So ultimately, what feeds through to your personal return that you have to pay income tax, that's where you're motivated to do some savings. And I guess our value proposition, I think, Leo, there's a slide you can, for those who are interested that want to have my contact information. One of the things that we do is we can go ahead and send you over information pertaining what would be needed for our actuaries to be able to put together a customized illustration for you and your business. And then from there, you can make business decisions on, how much taxes you want to go ahead and save. And then there's no cost associated with doing that. The way our firm looks at it is we all vote with our money on who we want to work with, what value resources do they bring to the table. And if there's a value proposition we bring to the table, you'll naturally want not only for this to be a starting point in a relationship, but the other thing you'll ask is, well, what else do you have? What other ways can you help regards to advanced tax, estate, financial planning, liability, insurance management? We literally do everything when it comes to working with a dollar.
Great. Well, thank you so much, James.
And we work with
information.
Yeah, the question, we're just outside of Florida, yes. All throughout the United States, we're in Canada, in Europe, and Israel. So we're a worldwide organization.
Excellent. Well, thank you so much, everybody, and have a great afternoon.
Very good. Have a great day.